Hi, Prajesh. Can you hear?
Hi, good morning.
Good morning.
Yeah.
Shihabuddin is not there?
No, he's in India right now.
Okay. He said he will join through online.
Yeah, we'll check with
Okay,
him.
fine. So now here we are going to discuss about cost and variance measurements. Like in budgeting, we studied about static budget, this flexible budget, and how to prepare a budget and all. So now, when it comes to analyze, why we prepare budget as a control measurement, right? When we have a budget, we can plan according to the budget. We have something to match with. We will have a benchmark for testing whether we are reaching our target or not, all those things. So how we will know this comparison, how we will do this comparison? That is a variance analysis we do. Variance analysis between budgets like flexible budgets and static budgets we do. Then labor variance, direct material variance, and all other kind of variance like sales variance, overhead variance. All these variances we will analyze to find out whether in actual figures and the budget where we are lagging. Are we ahead of the budget, or are we lagging with the budget? That we will know from the variance analysis. Okay. Now, variance analysis overview. Use of a budget. Uh, Uses of budget. A budget communicates to employees the organization's operational and strategic objective. The budget quantifies the operational steps that ultimately lead to the achievement of strategy objective. That's why when we prepare the budget, we have the sales budget, production budget, purchase budget, all those things. So from this, employees will understand how much quantity they have to purchase or how much quantity they have to sell or produce. This employees will understand. Then a performance evaluation system must be used to monitor progress towards the budget's objective. So that means we have to compare our actual figures with the budgeted figures. Then feedback should be timely so that the managers can take corrective actions. Like when we compare the actual figures with the budgeted figures, if we see any deviation, that should be corrected at the same time. Then information sent to top management is ordinarily more highly aggregated and less timely than the communicated to managers at operational levels. Top managers are concerned with the organization's overall financial results and long-term prospects and are responsible for the strategic planning function. Then lower level reports contain more quantitative information of an operational nature, that's production data, etc. Okay. Then comes the variance analysis. So variance analysis is the basis of a performance evaluation system using a budget. Variance are the difference between the amounts budgeted and the amounts actually incurred. Budgeted figures and actual figures compared. Then, a primary reason for calculating variance is to notify management whenever an unusual event has occurred. Like for example, if you have budgeted for 1 year and you have broken into monthly budgets, now whenever you prepare your monthly profit and loss account or financial statement, you will compare with the budgeted figures. Then you will find out, for example, you budgeted 20,000 sales this month on January, but actually what happens, there is only 15,000 sales. So what you have to do on February sales, next month sales, you have to add the lagging part or the lost sales you should recover in your second month. So then only you can achieve your yearly target. Then okay, then management uses the information to improve future performance forecast and take early corrective actions. Then variance may be favorable or unfavorable. So variance means it can be favorable or unfavorable. Like for example, we targeted for 20,000 unit sales, but actually we sold 22,000 sales, unit sales. Then it's a favorable variance. If we didn't reach our budget, then we will say that the difference is called unfavorable variance. So whether a variance is favorable or unfavorable depends on how it affects income. A favorable variance increases income and and unfavorable variance decreases income. For example, what if when you budgeted salary for $20,000? Actually, what happens? 21,000 was the salary. Is it a favorable variance or an unfavorable variance? You budgeted 20,000 for salary expenses, but in real, actually, it happened 22,000. This 2,000, the difference
unfavorable.
Unfavorable, yeah. Why? Because it is decreasing your income. If it was about the revenue, like you budgeted for 20,000 and you reach 25,000, then 5,000 is your favorable variance.
If there is no difference, what we call like 20,000 budgeted and reach 20,000 only.
We don't
So,
need to mention anything about that.
Okay.
Okay. So when we prepare this variance analysis, we would label it for favorable variance as F and unfavorable as U. Yeah, then on the revenue side, for example, a favorable variance occurs when the actual revenues exceed budgeted revenues, and an unfavorable variance occurs when actual revenue are less than the budgeted revenue. Then when it comes to the cost side, favorable variance occurs when actual costs are less than the budgeted cost, and unfavorable variance occurs when actual cost exceeds the budgeted cost. Here we have an example. Unfavorable variance. Under efficient conditions, a worker should complete 1 unit of product per hour. If workers are normally paid $6 per hour, the standard labor cost per unit is $6 per unit. If the actual per unit amount for a 1 week period were 1.1 hours at 6.25 per hour or 6.88 per unit, the variance is $0.88 per unit. The variance is unfavorable because the actual cost exceeded the standard cost. So here, what was that? Standard was that in 1 hour, a labor should complete 1 unit, okay, and his salary will be $6. Okay, so what happened here? On an average, he took 1.1 hours, okay, to produce 1 unit, as well as the what. So what happened? Yeah, labor cost went to 6.25 hours. Clear? Got it? Then what happens? So your total cost for producing 1 unit became the labor cost for producing 1 unit became 6.88. So 8.88 is your variance, unfavorable variance.
How we got 6.88?
6.88. I'm just checking. Uh, 6.88.
Or 6.88 per unit.
It's a 1.1 hours into 6.25. Labor hour per hour rate is 6.25, right?
Per hour 6 is right.
6 6 per dollar was our standard rate.
Okay.
But actually, what happened? We were paying 6.25 per hour.
Okay.
And this labor was inefficient, was not efficient as per our calculation. He took 1.1 hours. So what happened? For producing 1 unit, we had to pay 6.88 per unit. Clear?
Okay. Okay.
Yeah. Next, the significance of variance depends not on the other amount, not only on the other amount, but also on their direction, frequency, and trend. Persistent variance may indicate the standards need to be reevaluated. For example, you budgeted sales. For example, for monthly sales, you budgeted 20,000 units every month. But what happens in real case when you compare the actual figures, you are attaining only 10,000 unit sales every month. So what does it mean? And this happens consistently. Whatever pressure you put on your sales team, they can't attain more than the 10,000 units. It means that you have to revise your standard. The budgeted standard which you did had some problem. Maybe you didn't consider the market condition, or you missed out your capacity, or anything it can be. Clear? So variance analysis enables management by exception.
Once, can you explain that example again? That unfavorable variance, I'm not getting that. 0.88.
this point, right?
No, that previous 15.1 example.
Okay.
In that, for 1 unit he gets it is $6 per unit, correct?
$6 per unit was the standard rate.
Sorry, per hour.
Per hour was the standard rate. Okay.
Yeah. So in 1 hour he gets $6.
Yeah.
So in 1.1 hours we should be paying him 6.6.
No. What happened? This is the okay. See, I will put an Excel just show you. See, actual quantity into actual price. Okay, and standard quantity into standard price. Okay, so standard quantity was 1. In 1 hour, he can produce 1 unit, right?
Yes.
So the rate is $6. So how much it will cost to the company for a product? $6, right?
Yes.
What happened here? And actually, what happened? He was taking 1.1 hour to complete 1 unit. Clear?
Okay.
And the actual price we had to hire one employee was 6.25.
Okay.
So what happens? Our total cost increased. Clear?
Yes. Fine. 0.88.
0.88. And one more thing is that here actually what happened is there is two kind of variance happening. Okay. One is
Variance in the hours plus the variance in the amount.
yeah, one is efficiency variance, right? We were expecting that employee will produce 1 unit in 1 hour, but he took 1.1 hour. Got it?
Okay.
So there is efficiency variance. In addition to that, there is also price variance.
Okay.
We expected to purchase the labor hour for $6, but the labors was costly, so we had to pay $6.25. So ultimately, when there is what we say, our total cost can be or labor cost can be can have a variance because of performance variance and price
Efficiency.
variance. Clear?
Price and efficiency.
Got
Okay.
it? Price and efficiency.
Yes.
Yeah. Okay.
Fine.
So then here variance analysis, the significance of variance depends not only on their amount but also on their direction, frequency, and trend. Then persistent variance may indicate that standards need to be re-evaluated. Then variance analysis enables management by exception the practice of giving attention primarily to significant deviation from expectations, whether favorable or unfavorable. Concentrating on the operations that are not performing within expected limit is likely to yield the best ratio of benefit to cost. So here, this is what we studied in one of the chapter, like bottleneck. You remember this word, bottleneck?
Yeah, yes.
Yeah, in bottleneck, what were the function we were doing? If we want to increase the productivity of the manufacturing or production department, we are supposed to first deal with the bottleneck, right? Which is making the lag in the production, correct? The same way, when you do the variance analysis, for which we see the maximum variance, okay, for that we should work. So when you put a cost on that, it will give more result. Like for example, you have 5 students in the class, okay, and you are the teacher of the class, for example. Out of this 50 students is having more than 80-85% mark, okay, and other 50 students is having only 20% mark, okay. The principal asks you to increase your average, your class average. Where do you will work? Hello. Anyone?
20% students.
20% students. So that what happens if you're working on an 80% student, you can, even if you put your 100% effort also, you can make him only 200. So you can increase only 20%, right? But if you're working on a student who is getting only 20% or 30%, the effort may be less, but you can get it. Okay, sorry, what was that? You can get more result. Got it? Concept is clear?
Yes, yes.
Yeah. Then assignment of responsibility. A crucial part of variance analysis is the assignment of responsibility. The performance measures on which managers are judged should be directly related to the factors that drive the element being measured. That's cost drivers and revenue drivers. The goal is to assign responsibility for variance to those most likely to have information that will enable management to find solution. A manager who doesn't control an activity may nevertheless be an individual who is best informed about it. Then, the constructive approach is to promote learning and continuous improvement in manufacturing operations, not to assign blame. However, variance analysis may be useful in evaluating managers' performance also. Clear? Then, overview of variances, that is static budget variance. So here, beginning of variance analysis is the static budget variance. The static budget variance measures the difference between the static, that means the master budget amounts, and the actual results. It is the total variance to be explained. So what happens? We first take our static budget, the complete budget, and we compare with our actual budget. So for example, here what you're going to do is you're digging into the truth. For example, monthly budget you prepared. You have a monthly financial statement as well as you have the monthly budget. So, for example, you are now going to compare your final budget, that means P&L, balance sheet, and cash flows with the actual results. So now what happens? You will get a variance, right? Because you compared with the actual and static budget. So this is the first step. When you see the variance, now you have to find out from where in detail the variance happens. For example, you are comparing your profit. You expected a profit of 25,000. When you calculated your actual profit, it is only 15,000. So there is a 10,000 unfavorable variance, right? So now you have to find out why you couldn't reach the profit you were targeting. So that's the second question arises after you do the static budget variance. Clear? Then flexible budget variance and sales volume variance. The static budget variance consists of flexible budget variance and sales volume variance. Okay, so when you compare to we compare the reason for the, we find the reason for the static budget variance. It can be because of the flexible budget variance and sales volume variance. Okay, a flexible budget variance is the difference between the actual results and budgeted amounts of the actual activity levels. It may be analyzed in terms of variance relating to selling prices, input cost, and input quantities. Then flexible budget must be based on per unit variable cost and the total fixed cost. Thus, it consists of the cost that should have been incurred giving the actual level of production. Actual production is actual output, but variable costs are measured using the standard level of inputs. So here, in flexible budget, what we do, we take the actual figures, like what was actual cost we were taking. Okay, then what else? Then okay, standard cost. Standard cost alerts management to cost problems, permit management by exception, and may increase the efficiency of employees who participate in setting standards. Standards costs are also facilitate flexible budgeting, performance evaluation, and setting employee goals. Then standard costs should be established for direct material, direct labor, and overhead. These standards can then be used to calculate variances. Standard costs exclude inefficiencies and reflects expected changes. their emphasis is on current performance and potential improvement. So here, when we set a standard, what we do, we consider all the possible things which could affect. Okay. What was that? Sorry. Okay, when we set the standard cost, we should consider all the possible changes which could happen in the market. We should accommodate it, but we will not accommodate inefficiencies. Okay, but we don't. Why? Because we don't know how inefficient will become the machine or human being. So what we'll do, we'll take the ideal figures for the standard costing. Then sales volume variance. Sales volume variance is the difference between the flexible budget and static budget amounts if selling price and cost are consistent. Okay. If selling price and cost are consistent, then what can bring the change in the sales value? Selling price and cost is consistent. So then the variance can arise because of the quantity, right? Okay, so here actual results and flexible budget and static budget. So actual results means actual input into actual price. Okay, flexible budget, what we take is standard input allowed for actual output into standard price. Then in static budget, we take budgetary inputs into standard price. So here we will compare static budget with flexible budget. You will get sales volume variance. And when you compare your actual result with flexible budget, you will get flexible budget variance. So this both figures should match with your static budget variance. Clear? Component of flexible budget variance. So flexible budget variance components can be either direct material flexible budget variance or direct labor flexible budget variance or factory overhead flexible budget variance. Coming to direct material variance, which can include price variance and quantity variance. Okay. Quantity variance, why? Because of the inefficiency, or it can be quantity variance can be divided into like what we say, the output of the quantity and the input. If there is a variance in the input, for example, if you're talking about a product which is manufactured with two commodities, then usually the input, if I put 5 units of input, I used to get 1 unit of output. Now what happens is there is a variance because I had to put 6 raw materials to get a final product. So this is why, because of the inefficiency. Clear? So when a product has more than one input, the materials mix variance and material yield variance can be calculated. So when you calculate the material variance, you can divide into two area, that is price variance and quantity variance. Then quantity variance can be divided into material mix variance and material yield variance. There. Direct labor variance also include rate variance and efficiency variance. Efficiency variance also can be divided into two areas. If there is labor mix variance and labor yield variance. Factory overhead variance have variable and fixed components. A four-way analysis includes 2 variable and 2 fixed components. There's variable overhead spending variance and variable overhead efficiency variance, fixed overhead spending variance, and fixed overhead production volume variances. Then components of the sales volume variance is when more than one product is made, the sales volume variance consists of the following, that is sales yield variance and sales mix variance. Okay, so sales volume variance is caused because of the sales yield variance and sales mix variance. What are the advantages and disadvantages of variance analysis? Advantages of variance analysis include that identifies areas where actual results are different from budget and management can take appropriate action, provides a basis for investigation that promotes an understanding of operations, promotes accountability among personnel, evaluates performance of personnel, identifies budget estimates, recurring revision. Disadvantages of variance analysis include the length of time it takes to identify a problem may be too long for management to effectively take action. There is a focus on the past without looking to the future. Static and flexible budget variance. So the static budget variance, static budget and actual results of the period are required to calculate the static budget variance. So static budget is prepared before the budget period begins and is not changed. So that's why we call it a static budget or master budget. If we will not change, for example, we are having a flexible budget, then what happens? We estimated a direct material cost of $50. So when we start working on that year, we came to know that this price is not attainable. So we will change it to the current market price, like for example, 55. That cannot be done in a static budget. So static budget is prepared before the budget period begins and is not changed. It is based only on the output planned at the beginning of the budget period. Then the static budget reflects management's best estimate for sales, production, input prices, labor and overhead costs, and selling and administration costs. Then standard prices. Standard prices are determined for underlying cost drivers. They are budgeted unit costs established to improve productivity and efficiency. The cost driver is used to assign cost to a cost object. It is measured by activity such as direct labor hours or machine hours that has a cause and effect relationship and with total cost. This is where it comes to the application, whatever we studied in our 7th to 11th chapters. Okay, 7 to 11 we were studying all about the costing, right? So those costing what we studied there, we will apply it here for the budgeting also. Then only we can compare our cost data with the budget, right? Then the standard price is not an average of past cost, but an objectively determined estimate of what a cost should be. It may be based on accounting, engineering, and statistical quality control studies. A standard price can be compared to par on a golf course. Then standard price must be kept current to provide relevant information. If prices have changed considerably for a particular material, a variance is always reported if the standard price is not changed. Much of the usefulness of the standard price is lost if a large variance is always expected. And how we set a standard quantity? Standard quantity is the objectively determined estimate of the quantity expected to be produced. Ideal standards are standard cost under optimal conditions. They are based on the work of the most skilled workers with no allowance for wastage, spoilage, machine breakdowns, or other downtime. These tight standards are not in wide use because they are difficult to attain. Then practical standards are defined as the performance that is reasonably expected to be achieved with an allowance for normal spoilage, wastage, and downtime. Practical standards represent possible but difficult to attain results. Thus, practical standards are useful in determining standard quantity. Right. So once all standard prices and standard quantities are determined, the static budget can be calculated. That is standard quantity into standard price. You will get the static budget amount, right? It can be for sales or purchases. Okay. Then the actual results are compared with after the budget period ends. The actual results reflect the revenue actually earned and the cost actually incurred. So here actual quantity and actual price, you will get actual results. Static budget variance is the difference between the static budget and the actual results for the period. The static budget variance provides useful information, but it does not explain the cause of the variance. Okay. Here, what we do when we do the static budget variance, we just get a variance. After getting this, we have to go in detail to find out what is the cause of this variance. Clear? So here, so static budget variance means actual results minus static budget. So here, so when you do, for example, you have the actual results of this unit sold, revenues, variable costs like direct material, labor, everything. So now what we do, we will compare our actual quantity in the actual price. You will have the actual rates here. You will compare with your standard quantity and standard price. So variances you will record as this, like see units sold. It's for example 18,000 is the standard budget you have, static budget you had. And actually you reached only 16,500. That means 1,500 is an unfavorable variance for you. So this variance analysis you will do for every headings. Okay. So what you will get, the total static budget variance is minus 97,950. Now we have to find out, for example, a direct material variance. Why it is cost? Maybe because of the actual prices more than standard price, or we consumed more quantities, actual quantities than standard quantity, or maybe both of them have changed. Actual price also have a deviation, actual quantities also having a deviation. So that we will find out when you do the direct material variance. Clear? So here interpretation of the static budget variance can sometimes be misleading. For example, the 160,500 variance on direct material in example 15 point, this one, okay, is labeled as favorable because actual cost was less than the standard. However, if the variance was mostly the result of production being lower than planned, the favorable variance resulted regardless of the action of the manager responsible. In fact, he may have been the cause of production delays, which led to the use of fewer materials. Flexible budget using standard cost helps management determine how much of the static budget variance arises from inaccurate forecast of output sold and variation in the effectiveness and efficiency of actual outputs. So flexible budget and sales volume variance. So flexible budget variance and sales volume variance are based on flexible budgets. If flexible budget adjusts for changes in the volume of activity, it can be adapted to any level of production. Budgeted revenues and costs are based on the actual quantities and standard cost. So here, for flexible budget, what we'll take? We will take the actual quantity, which will be compared with the standard price. So that's called the flexible budget amount. Okay. So flexible budget variances result from variations in the efficiency and effectiveness of producing actual output. They are the difference between the actual results and flexible budget amount. See here, when we have a variance from what we expected, okay, here we are taking the same rate. That means the standard price we are taking for actual quantity and standard prices we are taking for, let me say, we're comparing here, the actual quantity is taken here, okay. So for example, we sold 10 quantities. So here, both places, it will be 10 quantities. Only the difference will be caused by actual price and standard price. Clear? So actual quantity into actual price minus standard price, which will give you flexible budget variance. Sales volume variance. So sales volume variance result from the inaccurate forecast of output units, output sold. They are the difference between flexible budget amount and static budget amounts. So here what we'll do, standard quantity into standard price. There's a static budget. We compare with our actual quantity and standard price. Here what happens here? Here it's only quantity variance is happening, right? Because both places we are having standard price. Clear? Lawrence?
Can you just explain once again, like in the budget variance, why we take the actual price. So if it is in terms of rupees, I mean in terms of amount value, then we take the actual price, we compare with the standard price. And when it is in terms of quantity, we take the actual quantity and compare it with the standard quantity.
See here, in this what happens, I think you remember price variance and quantity variance, right? You studied in standard
Yes.
costing. Okay,
Yes.
so here what we are trying to establish is price variance. Clear?
Okay. Okay.
In next position, sales volume variance, we are trying to
The
establish
quantity variance.
clear.
Yeah. So we compare. So whatever variance we are trying to establish, we compare that with the actual.
Yes.
The standard with the actuals.
No, here see, if I want to, for example,
Yeah. If I'm doing the budget or the budget or the variance, then
yeah,
I compare my actual price with my standard price,
yes,
and the quantity I keep the actual quantity.
actual quantity. Got it.
And if I'm doing the quantity variance, I compare my
Yes.
actual quantity with my budgeted quantity, and the price I keep the
Standard price. Got it.
standard price. Why not the actual price?
No, when you keep the actual price, it will not give you how much quantity is the difference there. Got it. You didn't understand.
No, I don't understand why not the
Yeah,
actual
okay.
price.
We will take one example. Let me think for an example. Okay, for example, we were planning for standard quantity and standard price. Okay, so here we were expecting when I put two quantities, okay, of some raw materials, I will get 1 unit of output, and price for each unit is, for example, $5.5. So how much should be the cost? It will be 11, right? Okay. Then actually what happened, actual quantity and actual price. Quantity was saying, okay, here when I purchased, the price was different, that is it was $6. Okay, so here when we do the budget comparison, we will not get these figures. We will not get what is actual price and actual quantity. Got it? This is not available. Yeah, when you're preparing actual, so that's why we don't know what is the variance cost. Here when you compare, for example, this is your cost. Okay, this is a standard cost. Okay, and this is your actual cost. Okay, so when you did the comparison or static budget, this comes under your static budget, and this comes under your actual budget, right? So actual figure. So when you compare with the standard, you are having a negative or what we say unfavorable value, right?
Yes.
So you don't know what is the cause of this. Clear?
Okay.
So if you want to find what was the cause, what you will do? You will check both cases, whether take this formula, actual quantity,
yeah, whether I have a budget variance or whether there's a volume variance.
Volume variance. Clear?
Yeah.
When I put because you know this is because of the price variance. Why? Because I put this data. If I gave you only these two data, how you will find?
Okay.
So that, for example, if you want to find what is the cause of the variance, so what you will do? You will do the what will take actual quantity and actual price into standard price. Actual price minus standard price. Actual price. Okay, actual price minus standard price, right? So you will get variance. Got it?
Okay.
What if it was in a reverse way, like price was same as we were thinking, okay, and in actual we took 3 units, so still there is a variance, but we don't know what is the cause of variance. Clear? So here what you will do, you will take your standard price. Clear? Why? Because the price have no variance, right?
Yes.
Okay, so 6 into what was that? 3 minus 2. Got it?
Okay.
Clear. One more example we will put. Okay, the same step. There is actually price variance. Okay, as well as quantity variance. Clear?
Okay.
Now what happens? Prices compared. Actual quantity, right? So you will take your actual quantity as 3. Here, standard price you take. Okay. Actual quantity. Now, what is the total of the variance you have? 7.5, right? Lawrence?
Yes. Yes.
Now, what we did is, when we did actual quantity, actual cost minus compared with the standard cost, you got a minus unfavorable 7.5, but you don't know what is the cost. Okay. When you did this comparison, the sales volume analysis, you find out that, okay, sales volume analysis is this downward. There is a $6 variance, okay? Clear?
Yeah.
There's an unfavorable variance 6 out of the 7.5. 6 is coming from price. What do we say? Quantity variance. Clear? Got it?
Yes. Yes.
Okay. And from this, you understood this variance is because of the price. Because there is a price variance, you had a $1.5 unfavorable. Clear? Now, as a management, what you will do? You will think, how can I resolve? How can I reduce this variance? So you will first negotiate with, either you will negotiate with your supplier for the rate. Clear? Lawrence, got it?
Yes. Yes.
Or you will try to find what is the problem of actual quantity and standard quantity you are having. Like maybe the production problem you have, maybe the raw materials which you are purchasing is not up to the standard what we are expecting. Clear? So here you will do the correction. If there is no deviation in price, you don't have to think about negotiating with the price, right?
Yeah.
You will just go for the production. What is the problem in the production? Clear?
Yes.
Good.
അമ്മോ നീ ട്യൂഷന് പോകുമ്പോ നാളെ മുതലോ ടൂർ പോയിട്ട് പഠിക്ക് ട്യൂഷന് പോവാ സ്നാക്ക് പൈസ കൊടുത്തതിനെ കുറച്ച് നോക്കും
Hello.
Yeah.
So other disturbance is there?
Yeah, I just muted. Someone mic was on. Okay.
Okay.
Fine. So coming to here, when you do the static budget, total static budget variance. So when we were doing this first variance, like how much was the total static budget variance? 97,950 unfavorable. Correct. Now we are going to find out what is the reason why. Where is the variance happening? Clear? We want to do what is the component of this particular static budget variance. So what you will do? You will take your actual results, okay, and you will compare with your flexible budget, and this flexible budget will be compared with your static budget. So when you compare your flexible budget with static budget, you will get total sales volume variance, and when you compare your actual results with your flexible budget, you will get total flexible budget variance. Clear? Okay, done.
Yeah.
Only this point is calculated. All these 3 columns are given. Actual results, flexible budget and static budget is given in the question. only the variable like variance is calculated here. Clear? You might think, right, these figures, from where did we got these figures? This is part of the question. Okay, done. So one more thing, in exam, how you might get a question, you might get the details of this with actual cost, flexible budget, and static budget. You will be asked to find out what is the flexible budget variance or sales volume variance or static budget variance. Unless you know with which you have to compare which. For example, if you are comparing with actual with your static, you will not get the answer, right? When you compare your actual with your static, you will get static budget variance only. Clear? When you compare your actual with the flexible, then only you will get total flexible budget. Clear? Okay, done. Next comes the direct material variance. Okay. Direct material flexible budget variance has price and quantity efficiency components. These two sources of the total variance can be isolated. Part of the total variance is attributed to using more or less materials than planned. Part is attributable to the price of material being different than what was planned. That's a price component. So here, that material flexible budget variance, we can divide into direct material price variance and direct material quantity variance. So direct material price variance, how you are calculating it. The direct material price variance equals the actual quantity of total input times the difference between the standard price and the actual price. So here what we'll do, actual unit produced into actual material per unit. Okay. So you will get what? Actual quantity, right? Are you getting? Hello.
Yeah, actual cost we are getting.
No, actual quantity we are getting. See.
Yeah, actual unit produced.
Yeah.
Okay.
See, for example, to produce actual material per unit, you have to put 5 units of input. Okay. Input to get 1 unit of output. You get 1 unit of output. So, for example, you are producing 50 quantities, for example, to sell. Then, how much raw materials you should have? Rajesh, you are producing 50 units. Your output is 50 units. So, how much should be your raw materials? Come on, anyone? That is 50 into 5, right? So when you purchase 250 raw materials only, then you can produce 50 units of output. Clear? Hello?
Yeah, yes.
So that is what we are calculating here. Okay? Into actual price minus standard price. See here, what the formula we had here before? Actual quantity into actual price minus standard price, right? That is the same thing we are doing here. Who's that? Actual price minus standard price. So this is what is the actual quantity. Got it? Lawrence, it's fine.
Yes, yes.
Then the price variance may be isolated at the time of purchase or when materials are transferred to work in progress. A purchase price variance is a non-manufacturing variance. It measures the difference between the amount paid for all units of material purchased during a specific period and the amount expected to be paid. This formula can be used to calculate variance at the earliest time possible, which is at the time goods are purchased. Once a variance has been calculated, the next step is to analyze the reason for the variance. In general, a favorable variance is desirable and an unfavorable variance is undesirable, but that is not always true. An unfavorable direct material price variance means that the actual price paid for the material is higher than the estimated standard price. This is usually undesirable. The purchasing function may be responsible under the assumption that the bought materials that the cost too much. Thus, an unfavorable variance is not the fault of the production department. Okay. Then, however, the unfavorable variance may simply indicate that prices in the industry have risen and standard price should be updated. Then, favorable direct material price variance may means that the purchasing function performed well by finding a lower cost source for the material. Okay. However, the favorable variance may simply indicate the price in the industry has fallen and standard price should be updated. Then another possibility is that the lower price may be attributable to lower quality materials, and an analysis may be made to determine whether the lower quality material results in a lower quality product or the use of excess quantities in production. In this case, the purchasing function is at fault. This variance is generally considered the responsibility of the purchasing manager and purchasing department. So, is it always when we get a unfavorable variance, is it always correct? Like if we get an unfavorable variance, is it only because of the price variance? What can be? There are the reasons like the
Price and volume also.
Yeah, price in the market have already changed. Okay, but we didn't updated our standard rates. Clear? Okay. And second thing, if I am getting a favorable material price variance, here also there can be possibility that the market price for this particular raw materials have dropped, but we didn't updated our standard rates. Clear? Or there can be possibility that we purchase some quantities with lower quality. So when we purchase in lower quality, what happens? The price may be low, but the quantity used or consumed may be more. Because when you purchase low quality product, it will create more wastage and we have to use more product for producing the output. Then comes the direct material variance analysis. Okay. So the standard material. The direct material quantity variance equals the budgeted price times the difference between the actual quantity of total input and the budgeted quantity of total input. So here standard price into actual unit produced into actual material per unit. So you will get the actual quantity, right? Here actual unit produced into standard material price. So here you will get the adjusted standard price. Okay. Adjusted standard price means your standard price is adjusted standard quantity. You are getting a quantity which is adjusted to the standard price. Clear? When calculating the quantitative variance, the standard quantity equals actual units produced times the standard materials per unit. This equals the materials that should have been used given the actual level of production. The actual cost of the material is ignored because the variance associated the effect that would have occurred given no price variance. So here we are not comparing the price variance. Okay. You are taking only the quantity variances. Okay. Once the variance have been calculated, the next step is to analyze the reason for the variance. Here, the variance may be caused because of the quantity, right? So, in general, a favorable variance is desirable and unfavorable variance is undesirable, but that is not always true. Then, an unfavorable material quantity variance is usually the responsibility of the production department and may indicate an excessive use of material. It also may indicate theft of material or other wastage or shrinkages. Then, however, the excessive use might be attributable to using lower quality materials that were purchased at a lower price. An alternative explanation is that excessive usage may have been caused by using unskilled labor. Thus, a favorable labor rate variance may be contributed to an unfavorable material quantity variance. You're getting the reasons, right? Understanding the reasons? Lawrence, all fine?
Yeah.
Yeah. Unfavorable material quantity variance may indicate that workers have been unusually efficient, for example, by reducing normal spoilage. However, the reduced usage may indicate that they are producing lower quality products with less than the standard quantity of materials. Accordingly, a favorable variance is not always desirable. It may be as bad as or worse than an unfavorable variance. It may suggest that the costs have been reduced at the expense of product quality. The variance is generally considered the responsibility of the production manager and production department. Direct material flexible budget variance here. Sharon Incorporation estimated output for the period of 18,000 units. Our actual output was 16,500 units. Standard direct material per unit were estimated 7.5, but the actual usage was 6.5 per unit. Okay. The standard price was budgeted to 6.75, but the actual price was 7. The direct material variance are calculated as follows. So how you will do? You have static budget materials, right? 18,000, and you have flexible budget and direct, like here you will consider your actual budget as your flexible budget also. Okay, then coming to the price variance. So units into materials per unit, right? Estimated standard price, standard quantity into standard price. You will get the, not the standard price, like 7.5 units you have to use to produce 1 unit of output. So you should standard quantity will be 135,000. Clear? And your standard price will be 6.5. So 911,250 will be your standard price. So this is standard price. This is standard quantity. Next, what you're going to do? You are taking your actual quantity into standard price. No, actual quantity into, sorry, just a second. Okay, actual quantity into actual materials used, standard materials used. So 123,750. That means this is a adjusted standard quantity. That means adjusted to the actual results. So this is a adjusted standard quantity into standard prices. You will get 835,000. Then actual cost will be 16,500 units into 6.5 units which you used. And so your total quantity will be, actual quantity will be 107,250. And your actual price is $7. Okay. So what happens when you compare your direct material price variance? What do you have to do? You will take the actual quantity into standard actual price minus standard price, right? $7 in minus $6.75. You'll multiply with your actual quantity. You'll get an unfavorable variance. Why? Because the price which we are expecting was 6.75. The actual cost of material is $7. So there is an unfavorable change. Next, that material quantity variance. So here you will compare your actual quantity with your adjusted standard quantity. So 107 minus 123. So you will get a favorable variance of 111,000. Clear? And how to get the direct material variance? So you will compare your standard quantity here, what we say, standard quantity, and what we say this actual quantity. You will minus, you will get the what we say. A second. 135,000 minus 107,250. No, the difference. Just a second. Okay, flexible budget variance is component of like direct material price variance and direct material quantity variance will give you the direct material budget variance. I was trying to reconcile the variance. Then comes the service organization. In a service organization, the direct material variance are usually immediately compared with the direct labor variance. The reason is that only a relatively small investment is made in the direct materials because this organization tend to be labor intensive. So we'll continue direct labor variance from next class. Okay, on Tuesday. Fine.
Yeah. Okay.